In this complete guide to smart money and ICT concepts, you will learn how to define market structure, mark swing highs and swing lows, and understand how buy-side and sell-side liquidity drive price from one level to another. We will break down equal highs and equal lows, fair value gaps, order blocks, discount and premium, and refine execution with optimal trade entry using Fibonacci. This is a structured framework designed to show you how price truly moves in the market. If that sounds different from what you are used to, it probably is. Most traders spend years jumping between indicators, scalping strategies, and supply and demand models, yet still struggle to understand why price moves the way it does. Professional traders do not rely on indicators alone. They focus on structure, liquidity, and imbalance. If you want to understand how professional traders read the market and how liquidity actually drives price, this video was made for you. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before going any further, we need a clear way to define direction. So how do we actually determine whether a market is in an uptrend or a downtrend? Markets move through different phases. At times, price trends higher in an uptrend. At other times, it trends lower in a downtrend. And there are also periods of consolidation where price moves sideways and direction is less clear. In this video, we will focus specifically on trending conditions. Let us take an uptrend as an example. During an uptrend, the market does not move straight up. Instead, it moves in a structured way, forming what we call higher highs, usually marked on the chart as HH, and higher lows, usually marked as HL. They are called higher highs because each high is higher than the previous one, and higher lows because each low is also higher than the previous one. In contrast, during a downtrend, price forms lower highs, marked as LH, and lower lows, marked as LL. They are called lower highs because each high is lower than the previous one, and lower lows because each low is also lower than the previous one. In an uptrend structure, each time price breaks the previous high and creates a new higher high. This movement is referred to as a break of structure, commonly abbreviated as BOS. Of course, markets do not remain in an uptrend forever. At some point, the trend begins to change. This shift occurs when the previous lows are broken, leading to the formation of lower lows. Before this break, price was forming higher lows. Once those levels are broken, they turn into lower lows. This break of the previous lows during an uptrend is known as a change of character, often abbreviated as CHoCH. It is called a change of character because the market shifts from an uptrend structure to a downtrend structure, and the cycle continues. During a downtrend, price forms lower highs and lower lows. Each time a previous low is broken, that move is considered a break of structure, or BOS. Later, if price breaks the previous highs and forms higher highs during a downtrend, that move is again referred to as a change of character, or CHoCH. This is a brief overview of how break of structure, BOS, and change of character, CHoCH, work together to describe shifts in market direction. But structure does not exist on its own. It is built from individual price movements on the chart. This brings us to the next concept. What are swing points, and how do they relate to liquidity? Swing points are defined as either swing highs or swing lows. To identify a swing point, we use a three-candle structure. In a swing high, the candle in the middle has a higher high than the candle to the left and a higher high than the candle to the right. In a swing low, the candle in the middle has a lower low than the candle to the left and a lower low than the candle to the right. Swing points are important because of how traders place their orders. Many retail traders set their stop orders just above swing highs or just below swing lows. As a result, liquidity tends to accumulate around these areas. In a long trade, both the stop loss and the take profit are sell orders. In a short trade, both the stop loss and the take profit are buy orders. This relationship between order flow and trade direction leads directly to the concepts of buy-side liquidity and sell-side liquidity. Above a swing high, there is a large concentration of buy stop orders. These orders come from traders who are short and must buy to exit their positions, as well as from traders who want to enter long positions if price moves above the high. In ICT terms, this area is defined as buy-side liquidity. Below a swing low, there is a large concentration of sell stop orders. These orders come from traders who are long and must sell to exit their positions, as well as from traders who want to enter short positions if price moves below the low. In ICT terms, this area is defined as sell-side liquidity. The identification of buy-side and sell-side liquidity levels is an important component of the ICT method and helps explain how price moves and where reactions are more likely to occur. Let's now move to a real price chart and look at practical examples of buy-side and sell-side liquidity. On this 5-minute chart of the mini S&P, price is currently forming a low. At this stage, this is a potential swing low because the candle to the left has a higher low. If the next candle also produces a higher low, this candle will be confirmed as a swing low, which represents a point of sell-side liquidity. Moving forward one candle, we can see that price does form a higher low. With that confirmation, this level can now be classified as a swing low. While focusing on this swing low, we can also identify the potential formation of a swing high on this candle. This is because the candle to the left has a lower high. If the next candle produces a lower high as well, this level will be confirmed as a swing high, representing buy-side liquidity. Moving one candle forward, we can see that this condition is met. As a result, this level can now be marked as a confirmed swing high and a clear point of buy-side liquidity. At this point, we also have the potential for another swing low. If the next candle produces a higher low, this level would be confirmed as a new swing low. Moving forward one candle, we can see that this does not happen. Instead, the new candle forms a lower low. This new candle now becomes a potential candidate for a swing low because it has a higher low to its left. On the following candle, we can see that a higher low is formed, confirming a new swing low, so we can go ahead and mark it. Over the next two candles, price takes out the previous swing high and then returns to test it from the other side as support. After that, during the next 4 candles, price continues to form higher highs and higher lows. Eventually, price produces a candle with a lower high, which confirms the previous high as a swing high or buy-side liquidity, and we can go ahead and mark it. On the next candle, price continues moving to the downside. Identifying swing points is a simple process, but it is important to practice it in replay mode or in real time. With repetition, this becomes second nature when marking swing points on live price charts. But identifying swing highs and swing lows is only the first step. The next question is why price is drawn to these levels in the first place. This leads us directly to one of the most important concepts in the smart money framework. What is liquidity and how does it really work in the market? To answer that, we must begin with a clear introduction to smart money and the fundamentals of liquidity within the smart money concept. Before we move into patterns and executions, it is essential to understand what these terms truly mean and how they function in real market conditions. Imagine that major financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To do this, they require a significant number of sellers and corresponding sell orders in the market. This is essential because without available sellers, no transactions can take place. Therefore, smart money needs to trigger the stop-loss orders already present in the market to execute their buy or sell positions. It is often speculated that smart money may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. This situation can create an illusion among retail traders, making them believe they are trading on the right side of the market. However, contrary to their expectations, the market moves in the direction of their stop-loss levels, and after triggering these stops, it resumes its normal trend. To thrive and succeed as a profitable trader, identifying liquidity on the chart is essential. These areas, where significant volumes of orders are present, provide valuable insights into market dynamics and help prevent substantial losses. Liquidity can be classified into 2 types: static liquidity and dynamic liquidity. Let's briefly explain both. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, It represents the elements that drive market movements. To better understand this, imagine a market structure like a rally wave, consisting of a high and a low. These highs and lows represent external liquidity. External liquidity pertains to the highs and lows within a rally wave. Conversely, the fair value gaps found within the range of the high and low are considered internal liquidity. Price in the market always moves between internal and external liquidity. Think of it as a continuous cycle where price moves either from internal to external liquidity or from external to internal liquidity. Looking at this schematic figure, it shows a rally wave moving upward, sweeping the external liquidity gathered above the previous high. After this, the price shifts toward internal liquidity, indicated by this fair value gap, to fill the gaps left behind from internal liquidity. The price then transitions back to the external phase. Essentially, the price moves from the fair value gap to external liquidity by sweeping the liquidity above this high. With the external liquidity swept, the price then aims to balance by targeting internal liquidity. This causes the price to drop and fill the most recent fair value gaps. Shifting our focus, let's examine the details of static liquidity. Static liquidity refers to specific zones in the market where a large pool of money is resting, such as stop losses or buy and sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. Static liquidity can be identified in various areas on the price chart, such as below equal lows and above equal highs, above swing highs and below swing lows, below or above dynamic trend lines and channels, inside order blocks, below or above support and resistance levels, in Fibonacci retracement levels, and near the daily candle's body and wick. Having a solid grasp of static liquidity zones reveals their profound impact on market price direction. Neglecting them can lead to substantial losses. Some of these zones and patterns are especially important as they are widely recognized by traders, attracting more stop loss and pending orders, increasing the likelihood of price moving toward them to absorb liquidity. Among these static liquidity zones, some formations stand out because they naturally attract large clusters of stop orders. This brings us to a very important distinction inside liquidity. So, what are equal highs, equal lows, and old highs and lows, and why do they matter? When we start marking swing points on real price charts, one important pattern quickly becomes clear. Some swing highs and swing lows tend to form close to each other, while others stand out on their own. This distinction allows us to classify highs and lows into two main categories. Equal highs and equal lows are formed when multiple swing points appear at roughly the same price area. To identify equal highs, we look for two or more swing highs that cluster near the same level. In this chart, 3 swing highs form in the same area, creating a clear example of equal highs. The same principle applies to equal lows. When 2 or more swing lows cluster together around the same price zone, they form equal lows. In this example, 3 swing lows align closely, indicating a buildup of equal lows. It is important to understand that equal highs and equal lows do not need to be perfectly aligned at the exact same price. What matters is the clustering of swing points within the same general area, which often signals a concentration of liquidity. Old highs and old lows are different. These are swing highs or swing lows that stand out because they are isolated from surrounding price action. They represent previous extremes that price has not revisited for some time. In the example of an old low, price trades below the level without closing below it, and then starts to move higher. This behavior highlights how price can trigger liquidity below an old low without accepting value beneath it. This idea is central not only to ICT concepts, but also to the broader understanding of market manipulation. Price often moves into these isolated highs or lows to trigger resting orders and induce retail traders to one side of the market before reversing. Understanding the difference between equal highs and lows and old highs and old lows helps traders better identify where liquidity is likely to be located and how price is more likely to behave around these areas. Beyond equal highs and equal lows and old highs and old lows, there are other key highs and lows that traders should be aware of on any price chart. These include the previous week high and low, the previous day high and low, session highs and lows, and intraday time frame highs and lows. These levels often act as natural areas of liquidity and help explain where price is more likely to react or seek stops. But once liquidity is taken, price does not move randomly. It often leaves behind clear signs of imbalance as it expands away from those levels. To understand that behavior, we need to look at another key concept. What is a fair value gap in the ICT method, and how does it help explain price inefficiencies? A fair value gap is a three-candle pattern that reveals an imbalance in price delivery, creating a gap between the shadows of the first and third candles. Let us first look at the bullish fair value gap, often referred to as BISI. BISI stands for buy-side imbalance and sell-side inefficiency. A bullish fair value gap forms when the upper shadow of the first candle does not overlap with the lower shadow of the third candle, leaving a clear gap between the two. To make this clearer, let us compare two price movements, one where a fair value gap is present and one where it is not. On the left, there is no overlap between the upper shadow of the first candle and the lower shadow of the third candle, which creates a fair value gap. On the right, the upper shadow of the first candle overlaps with the lower shadow of the third candle. The bearish fair value gap is commonly called SIBI, which stands for sell-side imbalance and buy-side inefficiency. A bearish fair value gap forms when the lower shadow of the first candle does not overlap with the upper shadow of the third candle, again creating a gap between the two. Let us make the same comparison for bearish structures. On the left, there is no overlap between the lower shadow of the first candle and the upper shadow of the third candle, resulting in a bearish fair value gap. On the right, the lower shadow of the first candle overlaps with the upper shadow of the third candle, which means there is no fair value gap present. Another important concept related to fair value gaps is known as consequent encroachment. This simply refers to the midpoint of the fair value gap or the 50% level of the gap. Fair value gaps can act as areas of support and resistance, similar to other structural levels. Because of this, it is important to observe how price reacts to the boundaries of the fair value gap and to the consequent encroachment level. Let us start with bullish fair value gaps. In an ideal scenario, price reacts at the upper boundary of the fair value gap by trading into it and then closing above it. This behavior suggests that price is respecting the fair value gap. Another valid reaction occurs at the consequent encroachment. In this case, price pierces the midpoint of the fair value gap and closes above it. It is common to see price retest the consequent encroachment shortly after. In the next illustration, you can see the bearish version of a fair value gap reaction. The principle remains the same, but the structure is inverted. Just like other forms of support and resistance, price can also move through a fair value gap and later react from the opposite side. In ICT terminology, this behavior is called a fair value gap inversion. On the left, you can see a hypothetical example of a bullish fair value gap inverting and leading to bearish price movement. On the right, a bearish fair value gap inversion leads to bullish price movement. This behavior closely resembles the classic switch and test seen with many support and resistance levels. Beyond fair value gaps, the ICT method also highlights related concepts such as volume imbalances and gaps. A volume imbalance occurs when there is a difference between the open and close of adjacent candles, even though trading activity exists within that area because the candle shadows overlap. A gap, on the other hand, occurs when there is a complete absence of trading activity between candles. In a bullish gap, there is space between the high of the first candle and the low of the second candle. In a bearish gap, there is space between the low of the first candle and the high of the second candle. In the illustration, you can see the bullish versions of a fair value gap, a volume imbalance, and a gap placed side by side for comparison. In the following illustration, the bearish versions of all three patterns are shown. Keep in mind that fair value gaps, volume imbalances, and gaps can often be used in a similar way when analyzing price behavior and potential reaction areas. Let us now move from theory into practice and observe some real examples of fair value gaps, volume imbalances, and gaps, starting with a very simple case. We begin with this 1-hour chart of the dollar index. By moving one candle into the future, we can identify the formation of a fair value gap, since the upper shadow of this candle does not overlap with the lower shadow of the previous candle. It is common for price to return to a fair value gap before continuing in its primary direction, although this is not the only way fair value gaps can be used. As price continues to develop, moving one more candle forward reveals an important reaction. Price trades into the fair value gap and then immediately reverses to the upside, continuing its main movement. Notice that if the lower shadow of the next candle does not overlap with the upper shadow of this candle, a new fair value gap is created. In the following candle, this is exactly what happens, resulting in the formation of another fair value gap. Looking closely at the next candle sequence, we can observe an inside bar formation that does not enter the most recent fair value gap. In the candle that follows, price trades into the fair value gap and closes above it, clearly reacting to that zone in a similar way to the previous fair value gap. After this reaction, price resumes its upward movement for several more candles. If we shift our focus slightly forward in time, one additional candle reveals the formation of a gap. As shown on the chart, this gap can be marked in the same way as the fair value gaps. The principle remains the same. This is an area that price can later return to from the opposite direction, and in some cases, we can also observe inversions. In the very next candle, price reacts to the gap in a similar manner to how it reacted to the earlier fair value gaps, and then continues moving higher. It is also worth noting that the current candle is reacting to a fair value gap that formed immediately after the upward gap. Staying with the dollar index, but now shifting to the 4-hour chart, we can see a clear example of a volume imbalance. There is a gap between the close of the previous candle and the open of the current candle, yet there is trading activity within that area, which characterizes a volume imbalance. Over the next few candles, we can see how this volume imbalance holds price, and eventually the market begins to rise from that level. These imbalances often appear during strong institutional moves, where large positions enter the market and displace price aggressively. When that happens, certain candles leave behind important zones that can later act as points of interest. So, how can we identify a valid order block on the chart? An order block represents a specific area on the chart where a large amount of capital entered the market, usually from big banks or major institutions, often referred to as smart money. Because these participants operate with significant size, their activity tends to produce strong and visible price movements. When price accelerates sharply away from a particular level, like in this example, it often signals that institutional orders were placed there. Moves of this magnitude require heavy buying or selling pressure, and the zone where those orders were executed is what we call an order block. In general, order blocks fall into two main categories. Bullish order blocks are created by aggressive buying activity, while bearish order blocks are created by strong selling pressure. Once an order block has been clearly identified, it often becomes an area of interest because price has a tendency to revisit and react from that zone. It is common to see price return to the order block and then respond with a bounce or continuation. In this example, entering at the order block would have produced a favorable move, clearly illustrating how price can react around these areas. At this point, you might be wondering whether order blocks are the same thing as support and resistance. While both concepts are used to identify important price levels, they are not identical, and there are key differences between how they function and how they are defined. The first difference lies in how each one forms. Order blocks are identified based on strong and impulsive price movement away from a specific area. When price expands aggressively from a level, that area can be marked as an order block. Support and resistance, on the other hand, require visible reactions over time. If price rejects a level once and then rejects it again later, that repeated reaction allows us to define a support or resistance level. Another important distinction is the way these levels are drawn on the chart. Order blocks are usually marked as broader zones or areas, reflecting the range where orders were executed. Support and resistance levels are most often drawn as single lines. Even when they are drawn as zones, they tend to be much thinner and more precise compared to the wider zones used for order blocks. A third difference relates to how often price can interact with these levels. Order blocks are generally considered a one-time use. Once price returns to and touches an order block, it is no longer treated as valid. Support and resistance levels, in contrast, can be tested and respected multiple times before they lose their significance. Even though order blocks and support and resistance are different concepts, they can complement each other effectively. When an order block aligns with a support or resistance level, this creates what is known as confluence. Areas of confluence tend to carry more weight, as price has a higher probability of reacting when multiple factors point to the same zone. Before we can work with valid order blocks, we first need to understand how to correctly identify them. Earlier, we mentioned that strong price movement away from an area can point to an order block. However, it is important to clarify that this alone is not enough. A significant move by itself does not automatically confirm an order block. There are specific conditions that must be met for an order block to be considered valid. With that in mind, there are 3 key rules used to define a valid order block. These rules are essential because without them, it becomes very easy to mislabel random price movements as meaningful structures. The first rule focuses on the presence of a fair value gap. For price to qualify as an order block, it must create a fair value gap immediately afterward. This gap is often referred to as inefficiency or imbalance. Whenever you hear these terms, they are simply different ways of describing a fair value gap in price delivery. To make this clearer, let us look at an example. Here we have 2 price movements that appear very similar at first glance, as both move strongly to the upside. The difference becomes clear when we look closer. The example on the left shows a gap between the upper wick of the first candle and the lower wick of the third candle. In the example on the right, no such gap exists because the wicks overlap with the candle body. This gap is what defines inefficiency or imbalance. Even though both moves are strong, only the left example qualifies as a valid order block. To mark it, we take the candle just before the inefficiency and draw a rectangle covering the entire candle, from the highest wick to the lowest wick. The second rule is that an order block must remain unmitigated. In most cases, order blocks are considered a one-time use. Once price returns and touches the order block, even if it is only a wick, that order block is no longer considered valid and should not be reused. To illustrate this, imagine you identify a gap or inefficiency on the chart and decide to mark it as an order block. If price later returns and touches that zone, even if only with a wick, the order block is considered tested. Once tested, it is no longer valid and should not be treated as a fresh order block. Although there are approaches that reuse mitigated order blocks, those will be discussed in other videos. For now, the key idea to remember is that order blocks are generally treated as a one-time use. The third rule, and the most important one, is that a valid order block must lead to either a break of structure or a change of character after it forms. To see how this works in practice, let us look at an example. In this chart, price makes a strong move upward and leaves behind a gap or inefficiency, suggesting a potential order block. However, this alone is not enough to immediately draw the order block. We must first observe whether price produces a break of structure or a change of character afterward. At this stage, we can see that price has not yet broken the previous highs, meaning a break of structure has not occurred. Because of that, we wait and allow price to continue developing. Once price eventually breaks this high and creates a break of structure, that is the moment when we can draw the order block on the candle just before the inefficiency. In the next example, price again moves aggressively upward, creates inefficiency, and then follows through by breaking previous highs. Since this sequence results in a clear break of structure, it confirms another valid order block that can be drawn. Identifying valid order blocks helps us understand where institutions have previously entered the market. But knowing where price reacted is only part of the equation. We also need to understand where price is positioned within the current range. When analyzing price within the ICT framework, one important concept quickly becomes clear. Price does not offer the same opportunity at all levels of a range. and context always matters. This observation naturally leads us to the idea of discount and premium as a way to frame price location more effectively. To understand how these zones work in practice, we must first understand the idea of a range. A range is simply the space between a swing low and a swing high, or between a swing high and a swing low. This range defines the boundaries within which price is currently moving. Let us take the example of a range that forms from a swing low to a swing high. To define the premium and discount zones, we divide this range into two equal parts. The upper half of the range is always called the premium zone, while the lower half of the range is always called the discount zone. So when using the Fibonacci retracement to define discount and premium zones, it is essential to draw it in the correct direction. In a bullish scenario, where the range is measured from a swing low to a swing high, the Fibonacci should be drawn with the 0 level placed at the swing high and the 1 level placed at the swing low. When we look for long trade opportunities, we want price to trade in the discount zone, assuming there are other elements supporting the trade idea. The deeper price trades into the discount zone, the greater the potential risk-reward ratio. This is especially true when the stop loss is placed below the swing low and the target is set near the swing high. For downward price movements, we measure the range from a swing high to a swing low. So in bearish scenarios, the Fibonacci retracement should be drawn in the opposite direction. The 0 level is placed at the swing low, and the 1 level is placed at the swing high. In this case, we want to look for short trade opportunities in the premium zone. The higher price trades into the premium zone, the better the potential risk-reward ratio, assuming the stop loss is placed above the swing high and the target is set near the swing low. This concept of discount and premium is very simple, but it is essential to keep it in mind at all times when analyzing price. It provides a clear framework for evaluating where price is located within a range, and helps define where higher probability trade opportunities are more likely to form, especially when combined with proper structure and confirmation. Once we understand whether price is in premium or discount, the next step is refining execution within that zone. This is where precision becomes important. What is OTE in the ICT method, and how does it help define higher probability trade entries? OTE stands for Optimal Trade Entry. It refers to a specific Fibonacci retracement zone that aligns with discount for long trade entries and with premium for short trade entries. The idea behind OTE is to refine entry timing by focusing on areas where price is considered optimally priced within a range. This specific Fibonacci retracement zone runs from the 0.618 level to the 0.786 level. The midpoint of this zone, which is the 0.702 level, is also highlighted. In this illustration, you can see an example of an OTE for a long trade. Notice how this zone falls entirely within the discount zone. It is important to observe how price action reacts to all three levels of the OTE, with particular attention to the 0.702 retracement level. In the next illustration, you can see an OTE for a short trade. In this case, the zone falls within the premium zone. The same principle applies here. It's important to observe how price interacts with each of the three levels of the OTE, especially the midpoint retracement level, just as we do when analyzing an OTE for a long trade. Let us now look at a practical example of how the OTE works on a real price chart. In this example, you can see the 4-hour chart of Euro-USD. An important swing high and swing low have already been identified. From this range, we can mark out the discount and premium zones. Recall that a range is simply the distance between a swing high and a swing low. We can then plot the OTE for this same range. Notice how the OTE falls into the premium zone in this example. If price returns to this area, the focus is on observing how price reacts to each of the three levels that make up the OTE zone. As price moves forward, we can see a reaction at the 0.618 level of the OTE. While this level can be used as an entry, it is important to remember that the higher price trades into the premium zone, the greater the potential risk-reward ratio. In the next chart, price initially reacts slightly to the downside, then returns back into the OTE zone. Price closes above the midpoint, but remains below the 0.786 level. On the very next candle, the market drops aggressively. Within one more candle, price reaches the swing low target. If a short trade was executed at the midpoint of the OTE with a stop loss placed above the swing high and a target set at the swing low, this trade would have delivered a 2.4 risk-reward ratio. In the final image of this sequence, price continues moving lower after the initial target is reached. This highlights an important point. While a 2.4 risk-reward ratio is solid, there was additional downside potential that could have been captured depending on trade management. Let us now look at a long trade example using the OTE. In this case, price has just formed a swing high. We first draw the discount and premium zones, and then plot the OTE using the range defined on the chart. In the next chart, price returns into the OTE within the discount zone and reacts at the lowest level of the zone. Price touches this level without closing below it, and shortly after, price begins to move higher in the direction of the previous swing high, which represents buy-side liquidity. So traders, market structure defines direction. Swing points reveal where liquidity rests. Liquidity drives price from one level to another. Fair value gaps and order blocks show where imbalance and institutional activity leave their mark. Discount and premium define location, and OTE refines execution. When these concepts are understood together, the market stops looking random. It becomes structured, logical, and repeatable. Focus on clarity, practice consistently, and let the framework guide your decisions. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.